Hello, Benedict. Good afternoon. How are things going, Benedict? Everything's fine?
Good, good.
Okay, great.
Everything's fine. How about you?
I'm great. Thank you. Do you miss do you miss do you miss home? Your hometown?
Not really, to be honest. I 4 years ago, I was 1 year in Canada for studies abroad, and I'm kind of used to the feeling of being far away from home. So I
Oh,
talk to my family a lot, but I don't really have like homesickness or anything.
oh really? Ah.
Yeah,
So you are kind of a person who adjusts to a new place very well, right? Hmm.
yeah. I think I was forced to in my childhood, to be honest, because my parents separated pretty early, and they lived at different places, and then I spent time at my grandparents, at home, at my mom's place, at my dad's place, at my cousin's place. So I'm used to many different homes and moving around a lot.
I see. I see. Okay, so from childhood, you get used to being in different places, right?
Yeah, kind of forced to live in different places and get used to different situations.
I see. Yeah. Okay, I see. So it may have some pros and cons, right?
Definitely, definitely.
Okay. Okay. Great. What do you think of Korea?
I really, really liked it so far. I think the people here are very nice and very, I think a little bit of shy maybe,
Hmm.
but in general, when you ask them something and they can talk English, very kind and helpful and polite. I
Hmm.
really like that about people here, to be honest. It's much different in Germany, I think, because in Germany we're more direct and
Yeah.
not as helpful,
Yeah.
maybe.
Yeah. Yeah. Germans are a bit direct and straightforward, right?
Yeah, I think you can also hear it in our language, kind of. It's a bit more harsh and direct.
Even though they speak Korean, I mean, even though you meet some Koreans who speak English, they may not be very as direct as Germans are.
Yeah,
Yeah.
definitely.
Because once they find that once they find that you are very kind of close to them, then they're gonna be more open to you. But before that, they kind of yeah, a little bit yeah, kind of distant. You may feel a little bit distant from ordinary Koreans.
Good to know.
Yeah, uh, yeah. So Koreans generally, I don't know, a little bit introvert rather than extrovert. But many people, many young people, I think, extrovert. But some are generally Koreans are a little bit introvert before they get to know each other very well. Yeah.
Yeah, I have the feeling too, to be honest.
Yeah. Good afternoon, everyone. Dongjun Kim, Xiong Kang, Kang Xiong, and Hyojin Yang Hyojin. Hyojin, everything's fine?
Yes.
Okay, I really appreciate you ask me questions. I really appreciate uh, your work. Okay, so please keep it up. Yeah,
Okay.
yeah.
Thank you for this.
No, no, yeah. I'm really thankful. Hello, everyone. Jenny Beckhoff. Sorry, my eyesight is pretty bad.
Yeah.
Yeah. You're from which country?
I'm from Uzbekistan.
Oh, Uzbekistan. Okay. I see. How's the weather in Uzbekistan around this time?
Sorry?
How's the weather in Uzbekistan around this time? It's getting colder?
It's quite similar to Korea.
Ah, okay. Maybe pretty good, right?
Yeah, actually.
Okay. I hope you guys had a chance to think of the formulas related to formulas for the equity valuation. So at the end of the day, I think most of you guys find that finance is much of the finance when it comes to valuation is related to the time value of money, right? So discounting the future cash flows. So what's really a difficult part of the valuation is to figure out the future cash flows, which is really difficult, right? And then you also need to figure out the required rate of return, which will totally depend on your expectations of the not just the market, but also overall economic circumstances. So if you know these two things, the fact that you estimate recovery return is actually it actually means that you take account of all the risks into the recovery rate of return. So at the end of the day, the valuation is about taking account of risks, all the risks around the investment you are thinking of making. So yeah. Okay, so let's get started. So today we are supposed to talk about capital budgeting, but we are a little bit behind schedule. But first of all, I had some emails and questions about midterm. But the midterm are supposed to take place around this time, right? But some students are participating in UCL's event. So I think it was suggested by the school that the midterm exam should take place after this event. So I'm thinking of timing midterm exam around maybe on 25th or 27th October. So 25th is a Wednesday, Tuesday, 27th is Thursday. How we gonna carry out the midterm exam? I'm gonna send you guys by email the midterm paper, and then at a specific time, probably this time, and then you wanna sit on the desk to solve the questions, and then you should return the email by 4, around 4. So you want to give it around 1.5 hours. Okay, pretty long time. So I don't want to. So I want to give you plenty of time to solve the questions. Okay, I don't want to push you guys for a lot of time. Any questions about the midterm, except for the dates? Okay, about the the chapters that the midterm exam is going to cover, where I think maybe cost of this capital budgeting included, and maybe one or two more chapters will be included in the midterm. Okay, so I try to, if as possible, I try to divide the whole semesters by 2. So the first half will be included in the midterm, the other half in the final. Okay. Any questions?
Professor, are we going to have one midterm exam? Because in syllabus, it says that we have 2 parts of exams.
Yeah, actually, without UCLZ, we are supposed to have 2 midterm exams, but I didn't know we only have a UCLZ event during this semester. So we only have 1 midterm exam and 1 final exam. Yeah.
Okay, thank you.
Mm-hmm. And I hope the students participating in UCLZ exam have a great time. Yeah. Must be very rewarding, right? Okay. Any other questions related to midterm exam? No? Okay. So today's topics are first follow up on the lecture 9, and after covering this, we move on to a little bit of capital budgeting. So we're gonna have second capital budgeting lecture next Tuesday. Okay, I didn't erase these notes. I did in the previous lecture, hoping that you guys be reminded of my explanation. But if you don't understand, then please ask me now. So did you guys had a chance to think over the reasoning behind this formula, and yeah, and digested yeah, the whole concept of this equity valuation? Any questions? No? Okay, great. Let's take this example. Sawbridge company is growing at a phenomenal rate of 30%, okay? Growing at a phenomenal rate of 30% per year for the next 3 years. And that the rate will drop to 10% per year. If the growth rate then remains at 10% indefinitely, what is the total value of the stock? Total dividends just paid for 5 million, and required rate of return is 20%. Okay, so we have required rate of return 20% discount rate, right? So as an investor, what they expect from this Sawbridge company is a 20% of return during the investment period. Okay, so any cash flows in the future should be discounted at this rate, 20%, right? Then, so once we know this discount rate, what we need to also figure out is cash flows, right? So cash flows from the stock is dividends, okay? So then dividends is $5 million, right? The most recent dividend is $5 million. So $5 million is the most recent one. So according the next 3 years, let's say year 1, year 1, year 2, year 3, year 4. Could you be on mute? I don't know. Hey, John. Could you unmute? Could you unmute? Hey, John. Hello. Ah, I can do that. I didn't know about this function. Okay. So year one. So up to next 3 years, so 1, 2, 3 years, the growth rate is 30%, right? Pretty phenomenal. So year one, the dividend amount, the cash flow is gonna be 5, right? But multiplied by 0.3, right? And year two, 5 multiplied by 1 plus 0.2 times, right? And year three, 5 multiplied by 1 plus 0.3 times, right? This is the cash flow over the next 3 years based on this information, right? And then the rate will drop to 10%, which means that in the year 4, the cash flow is gonna be 5 multiplied by 1 plus 0.3 times multiplied by 1 plus 10%, 0.1. All right? You get it? This is the dividend expected in year 3, right? So, but year 4, according to this, after 3 years, the growth rate will be 10% per year, right? So year 4, the dividend amount will be year 3 dividend multiplied by 1 plus 0.1. Okay, you get it? So this is pretty similar to this calculation, this pattern, right? Non-constant multi-stage growth rate. Multi-stage growth rate. During this period, growth rate is 30%. And from this period, indefinitely, 10%. So multi-stage, 30% and 10%, right? Up to here, 30%. And from 30 year, right? 10% indefinitely. That's why we call this multi-stage, growth rate. So now what we have to do is discounting these cash flows, right? So we discount these cash flows. Okay. One plus discount rate 20%, right? 1 plus 0.2, 2 times 1 plus 0.2, 3 times. And this one, right? We need to know the price of these shares in year 3. Okay. We need to know, because from year 3, the growth rate is going to be constant at 10%, right? So now we can, based on this, using this recovery return and the constant growth rate, we are able to calculate the price of the value of these shares at the point of year 3, right? As if year 3 is 0, okay? As if year 3 is a point 0, we may think of this cash flow as year 1, right? So we simply, if we know this cash flow, if we know this growth rate, constant growth rate, right? So then we can figure out the value of these shares at point 3, applying using the formula 20% growth rate, right? Sorry, 20% is recovery rate, and growth rate is gonna be 10%, right? We're gonna use the formula. Oh, sorry, where's it gone? Formula is R minus G 1 plus G D1, right? Or D1. Okay, so recovery rate of return is 20%, growth rate is 10%, and the D1 cash flow is this one, right? Okay. So then we have share price at year 3. And we should also discount this share price back to the present, as we did for this dividends. So we need to discount this the value of these shares from up to year up to we need to discount all the cash flows generated after year 3, right? So all the cash flow generated after year 3 is the price, the value of these shares in year 3. Okay, we can calculate this, and then we need to know. We need to discount this value in year 3 back to the present. So we discount and what time? What times? What times? Ajarim.
Yes, Professor.
So divided by 1 plus 0.2% powered by one number.
Sorry.
So we need to discount this the value of the shares in year 3, right?
Yes.
Back to the present. So then the formula would be value of shares in year 3 divided by 1 plus 0.2% and powered by what number? 1, 2.
5.
5?
Yeah.
As I
Oh,
said,
wait.
this is the value in year 3.
Yeah.
Sorry? Sorry? What did you say?
Nothing. I said yes.
Yeah, it should be 3, right?
Oh, okay.
Yeah, this is the value we calculated at the point in year 3, right? So
Oh, okay.
in
I
year
get it.
3 we have this dividend amount, and also we at year 3 we have this dividend amount, and we have this value of shares for the dividend from year 3 indefinitely, right? So if we add all this 1, 2, 3, and 4, then we're gonna have the value of the stock issued by Surridge company based on these dividends and the growth rate and the required rate of return. Okay. This is just one way of valuing the equity. There are also many other ways, but this is one of the most popular ones. So the key is that how we gonna decide these cash flows, and how we gonna decide this recurring rate of return, how we're gonna decide the growth rate. So, but in reality, that is really painstakingly hard, right? As you may imagine. But we are just given that all these required rate of return and the growth rate and the dividend amount expected, right? Oh yeah, it is possible that we get it is possible to get the most recent dividend amount, but the growth rate and required rate of return to estimate is estimated is a little bit hard to forecast. Any questions?
No, sir.
Okay. If based on the formula, if we do not have any, if the growth rate is 0, then the price of the value of the shares is gonna be calculated using this formula, right? Let's say the most recent dividend, right? This is supposed to be oh no, this is supposed to be the value of the shares, right? But if we assume 0, the growth rate is 0, then it's gonna be, right? Okay. When it comes to the growth rate, growth rate is, it can be estimated using this formula. The B is a dividend growth rate, B is earnings retention rate, and ROE is return on equity. So if you multiply retention rate with return on equity, so then you may get a kind of a ballpark numbers of the growth rate, right? Why? Because once, as you can see here, the retention rate is calculated deducting the dividend payout ratios, right? In the total profit. So return on equity is the total profit, total, let's say, here's return, let's say return here is profit, right? Profit before any distribution. Okay, before any distribution to the shareholders. But once the distribution is made, then the company has no capital, less capital to generate the profit in the future, right? So this the dividend payout is the is going to reduce the future. It's going to reduce the power of generating future profit of the company. Okay, but if the company still retains the capital, then the capital can be used to generate more capital and more profits in the future, which is helpful for the growth of the company. Okay, that's why okay, dividend ratio, it looks like this. Total profits. Okay, it looks like this. Total profit. Total profits before any dividends. Before any dividends. Okay, and the total profits before dividends minus any dividends. Okay. So this let me see a little bit more clearly. We may rewrite this formula like this. Profits before any dividends. Okay, so profits before dividend minus dividend. Okay, so then you're gonna have profits before dividend, profits before dividend minus profit before dividend and dividend. So this is a total profit, right? 1 minus, and this is dividend ratio, dividend portion of the total profit. So dividend payout ratio, dividend payout ratio. So the more the dividend is distributed to the equity shareholders, the less the company has the power to generate profit in the future, which means less growth. That's why we deduct this dividend ratio from the total profits. Okay, and then this is kind of a source of this is kind of one source of capital in generating return in the future. So if you multiply this capital, right, equity capital with a return on equity, okay, so then you can get some ballpark number of growth rate. Why do we multiply return on equity? This is the this is kind of a capital, right? Equity capital. Equity capital remaining with the company, and then this is the kind of return on equity is the is the level of a profit the company generating using this capital, right? Buying asset based on asset and running the asset based on their business model. Okay, so the higher rate of return is gonna help the company grow, right? And higher equity capital is also gonna help the company, grow. Okay, so less dividend payout means that in this formula, right? If the dividend is lower, okay, then the growth rate is going higher. Okay, so then, or if the dividend is higher, growth rate is gonna lower, right? So one way or another, the value of the shares is gonna increase. Okay, you guys understand? So it depends on whether the company has any strategy, any business investment opportunities based on the equity capital. So if they have any investment opportunity, then they're gonna they may not distribute a huge amount of dividends. They try to utilize internal capital rather than distributing the profits to the shareholder. So then the growth rate will increase while dividend amount decreases. But in the end, value of the shares, depending on the rate of return, depending on the growth rate, still value of shares will increase based on this formula. So you should understand the kind of relationship between this growth rate and the value of the formula for the valuation of the equity. Connie, you understand? You're there?
Me, Professor?
Oh yeah, your name is sounds similar. Kenny, sorry.
Yes, Professor. I thought you were calling my name.
Yeah, so you also understand?
A bit, not much, but if I revise it again after that, maybe I can totally understand it.
Okay. So is there, you can specify what makes you a little bit confused? Can you specify this?
No, actually, I'm trying to get the formula properly, but so I'm not able to get the formula the exact now. So like the getting the part each other. So I'll try it again later, and maybe I can get properly again.
Okay. I see. Yeah, I think many of you may have the similar stage as Gans, right? Because all the formulas are new to you guys. So I definitely understand it takes time to digest all these formulas and the reasoning behind that. Yeah, definitely. But I just hope if you can, please ask me what points should be more clearly explained to help you guys understand, yeah, this better, if possible. Okay, that would be really help. That would help you guys to save your time, because you guys not just to take this class but also other several classes, right? So you guys have always, yeah, enough, don't need to have enough time. Recurrent rate of return. I think we may have time to talk about this CAPM in later lectures, but just be aware that one way to estimate the recurrent rate of return is based on this formula or theory, the capital asset pricing model. I think we're gonna have a chance to go into more details about CAPM in later lectures. If you rearrange this formula, right? This is the same as D0 1 plus G, right? So if you rearrange this formula like this, right, to calculate recurrent rate of return, you can define the first part of the function, first part of the ratio is dividend yield. The other one is capital gains yield. Why? First one is pretty obvious, right? This is dividend, right? And this is the value of the shares. So this is dividend yield, right? And why G is called capital gains yield? Because, as you know, G is based on the retention rate multiplied by return on equity, right? But this is gonna, if the growth rate is if this growth rate increases, as you can see here, if the growth rate increases, then the value of shares is gonna increase as well, right? Based on this formula, pretty obvious, right? 1 plus G. As I just said, if the growth rate is increasing, then the value of a share is supposed to increase as well. This is mathematically makes sense, right? So the reason for the higher value of this stock is higher retention rate. Could be higher retention rate. Return on equity would not be change it. Would not change it because some of the capital comes from debt or either debt or equity. Maybe affected, but the whole point is that the less the distribution is made, the more the capital remains with the company, then the increased value of these shares is mostly attributable to the capital not distributed, right? So then this value will be only realized when you sell the shares. Okay, so that when you sell the shares, all the values of coming from all the values of the shares, all the value of the shares will be realizing capital gains rather than dividends amount. So at the end of the day, the capital gains and dividends are same. The only difference is if you accumulate dividends, right, without distribution, then you can realize the value of dividends into capital gains when you sell the shares. Okay, that's why this portion G is called the capital gains yield, because you have initial price, okay, and when you sell the shares, let's say, I don't know, let's say you sell the price of the shares, let's say P, and use initial investment. This is initial investment, initial price. This is initial price, okay? So then the difference is capital gain as far as the price of shares has increased from your initial purchase price. Okay, that's why this is called capital gains yield. This one is mainly the increased appreciated price, mainly attributable to this growth rate. Okay. As I explained, the growth rate is based on retention rate multiplied by return on equity. The retention rate is higher when the distribution is when the last distribution is made. When the distribution is less, the higher the retention rate is. Okay. You guys understand? Confusing?
Yes, understandable, Professor.
Great. Yeah, I'm trying to as possible as good I could to make you guys understood. Yeah. Anyway, take this example for yourself, okay? And this is the slide we already saw in the previous lectures. So we took this part, right? The other way of valuing the stock is multiplier model. So I think this is pretty straightforward. Then if you read this slide, then you may not have a much difficult understanding the logic, okay, reasoning behind this valuation method, okay? The stock valuation using comparison. So using these ratios, you compare the ratios of similar companies. So the higher the ratio of the company you are purchase, you have interest in, is more attractive, right? So the higher the better. Okay, not always the higher the better. Sometimes depending on your investment objectives. Depending on your investment objectives or a preference, not always higher the better, but the ratios is always useful in comparing one stock with the others, okay? So I'm gonna skip this part, just to try to read, please read and try to understand. If you have any questions, then please email. Okay, yeah, I'm gonna skip this part. 1, 2, 3, 4, 5. We have many questions. Let's take only one. This one. An investor expects a share to pay dividends $3 and $3.15 at the end of year 1 and year 2, right, respectively. At the end of the second year, the investor expects the shares to trade at $40. The required rate of return on the shares is 8%. So, and if the investors' forecasts are accurate, the market price of the shares is currently $30. But the most likely conclusion is that the shares are. So what we know is that market price of the shares is $30. So we need to there's a kind of theory efficient capital market, efficient capital market theory. So if the market price actually reflects the intrinsic value of the shares, then we don't. If you believe the market price is definitely the price that reflects the actual value of the shares, that we don't have to make any valuation. We don't have to think of understanding these formulas or whatever. But we don't think the market is perfect. Okay. So this market price of $30 may not be the same as the intrinsic value. Of the stock. So how we can get intrinsic value? We just learned the dividend discount model, specifically Gordon Growth model, right? As far as the dividend grows at a specific rate, right? So after getting this intrinsic value, you compare the value with the market price. So the question is, what is the intrinsic value based on this information? So year 1, the cash flow is 3. Year 2 is cash flow is 115. So from year 3, if you if you discount all the cash flow from year 3 back to year 2, you're gonna have the value of stock. You're gonna have $40 of a value of stock, right? Year 1, year 2. So what you have to do is discount this value year 0. Discount this cash flow back to year 0, right? Using this recurrent rate of return, right? 1 plus time. Then you're gonna have a number, right? So you compare this number with this market price. So if the value is higher than this market price, then this market price is undervalued, right? But if the market price is higher than your valuation, the market price is overvalued. If the same, both two numbers same, then fairly valued. Okay. So what we have discussed up to now is how to calculate this intrinsic value to compare with the market price. Okay. So I'm gonna skip question 2, 3, 4, 5. So I hope you guys have time to tackle these questions. Okay. Maybe I'm gonna send you guys the answers to this question in the near future, but before that, it'll be much good. It'll be much better for you guys try to solve these questions for yourself. Okay. Any questions up to now?
No.
No? What do you mean by no?
I mean, there's no question, Professor.
The questions means that you understand everything or what? Okay. Have your time, take your time, try to understand all the explanation I made. So I really understand that it takes time for you guys to digest all the things I told you. Gigafactory. This is kind of a bird's view of the factory set up in Berlin, Brandenburg. So Tesla, as I understand, so constructed a new factory, pretty huge one in Germany. So I have this YouTube video, but I don't think we have enough time to watch this YouTube video. But if you are interested, then yeah, pretty exciting to watch this factory. The reason I show you this factory is that every company is gonna make an investment to expand their territory, right? Not just in their own home country, but also other countries. So Tesla is not the exception. So this is from the annual report of Tesla. The part of the notes is that, yeah, they made a huge amount of investment, as you can see here, right? So cash flows for investing activities and their availability, capital expenditures were $6.5 billion last year, and yeah, in 2020, 6.2 billion. So pretty. So most of this amount was used for construction of gigafactories, Texas, and Shanghai, and Berlin and Shanghai, right? So when the company makes such a huge investment decision, they need to also make a valuation of the investment, right? Like we used a certain formula for the valuation of equity. So capital investment has their own some valuation techniques. So one is net present value method. The other one, payback period method. And so the one internal rate of return. Okay. All the chapters we learn are interconnected with each other, right? Especially the understanding of time value money is pretty important, because the concept, the time value of money, is applied to all the financing and valuation method. So as you can see, this capital the valuation for capital investment is also based on the time value of money. So net present value is project market value minus its cost. So this is how we calculate the net present value. Project in the market value minus its cost. Payback period is number of years before the cumulative cash flow from investment equals initial investment. So how long it takes, we take back all the initial investment. That's the payback period. Internal rate of return is the discount rate that makes the net present value of the investment zero. In other words, internal rate of return is the rate that makes internal rate of return is the rate for the break even of the investment. So yeah, the break even rate for the investment. Okay. So we are going to details into these three methods. You guys remember this case, jackpot? Right? Probably chat lecture 1 or maybe 2 or 3. So we skipped this part. But now I think it is good time to talk about this jackpot case. But before we talk about this jackpot case, I think we need to talk about these 3 valuation method in a theoretical manner. Okay. So I'm gonna go back to this case a bit later after, yeah, going through this three method. Net present value first. What's net present value? The present value is, as the name implies, you need to calculate the present value first. Okay, present value of all the cash flows in the future. That's the first thing. And then you deduct this all the cash flow, present value of the cash flows in the future cash flows, deduct this present value of the cash flows from initial investment. So 1 minus your initial investment. Okay. Then you're gonna have net present value. Initial cost. Not just initial cost, total cost. Okay. Initial cost. Yeah, initial cost. Initial cost. So if you deduct initial cost from this present value of future cash flows, then you're gonna have net present value. So if the net present value is higher than 0, then this investment is worthwhile, right? Because you have profits after this cost, right? So as far as the present value of an investment is positive, then that investment is not, should not be deserted. But you need to think of if you have a several investment, then you need to compare the net present value of each investment. So you want to pick up the highest net present, the highest present project with the project with the highest net present value, right? So anyway, before we think of the several projects, if you have one specific project, and if you know the cash flows in the future of the project, then you discount all the cash flows back to present, and you deduct the present value of the future cash flows. You deduct the initial cost from the present value of all the future cash flows. Okay, then you're gonna have net present value. Conceptually, pretty understandable, straightforward, right? This is the cash flows from the investment. And this is the cash outflows from the investment. This is just a conceptual understanding, okay? We are not going to details of such details of how to calculate these cash inflows, cash outflows. But we just assume that we have these cash inflows and cash outflows. That's all. And then based on the net cash flows, right? We discount these cash flows back to the present, right? Then we have this amount based on these cash flows. We also should know the discount rate, 15%. Okay. discount rate is required rate of return. This required rate of return is the your expectation from this project. But this required rate of return is, as I said in the beginning of this class, based on all the risks, including market interest rate, inflation, credit rating of the company, everything, right? Everything that's relevant to the project, all the risks relevant to project should be reflected into required rate of return. So the higher the risk is, the higher the required rate of return is. Okay. So it's pretty difficult to decide the required rate. Not just difficult, but it's going to be very time consuming, and it requires a lot of it takes a lot of efforts to get this required rate of return. But we are not talking about how to get this required rate of return. But if we just assume that we have certain rate of required rate of return, then we're going to use that to discount the future cash flows. Okay, then if you deduct the present value of cash flows, deduct the initial cash, the initial investment from the present value of future cash flows, then you want to have net present value. So this one is negative amount. Then this project is not quite worth pursuing, right? Because you're going to lose money based on this net present value method. Any questions? Sohyun? You are there, Sohyun? Sohyun, Min Sohyun? You are there?
Yes, I'm here.
So any questions?
I think I fully understand clearly.
You don't understand clearly?
No, I think I understand it.
You think you understand it?
Yes.
Not?
Sorry, I'm in outside, so I think it's not sounds like clear.
Ah, okay.
Sorry if it's like so noisy.
So what should what point, what areas you guys think I need to give you more explanation in this part? Which one? Okay, so you may think is something kind of some concepts may be irritating you guys, right? So please let me know what actually makes you feel a little bit kind of frustrated with understanding this whole concept or formulas or whatever. Please let me know. So then I tried to focus on that part. Okay. I'm very frightened of this silence. You know, I like you guys to be a little bit more engaged in the class. Yana, so you are a bit active. So Yana, you are there?
Yana is here, but she has connection problems, so she will come soon. But for me, I understood everything, majority, because I read the chapter before class.
Okay, so Paulina, what do you think? Do you guys are you okay? Are you fine with the explanation?
Yes, for me it's fine.
Okay, great. Myung-suk, are you okay? Myung-suk, you are there? Tantra, 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 Tantra. You are there? Tantra. Jiwon, Jiwon, Baekjiwon, Baekjiwon. You are there? Some students are away from desk. Right.
Sir, I actually think that some of us might have connection problems because I'm at Seoul Bridge and I couldn't hear for like 2 or 3 minutes earlier as well. So.
I see. Jongin, Benedict, Benedict, what do you have anything, any part that makes you feel a little bit frustrated?
No, actually, I don't. I think I have to like a few more exercises, but you already gave us a few, so I think I'll be fine if I do them and practice it a little, to be honest.
Okay. Let's take this practice using the Excel. Okay. This is pretty based on the formula. So you can use the Excel to calculate the net present value. So let's assume that this is initial investment, $10,000. Then every year you have a certain amount of cash flows, right? So then, and then the discount rate, recurring rate of return is 10%. Okay. Then first thing you have to do is net present value to calculate the net present value, right? So if you go to formula, finance, and NPV, then you can calculate present value. Okay. You cover only this part, not this one. Okay. And then if you deduct this initial investment, then you want to get net present value using the Excel. So all you need to know is future cash flows and a discount rate and initial investment, right? When it comes to nature and net present value, investments should be accepted if the net present value is positive, okay? If not, should be rejected. Net present value rule recognize time value of money. That's why? Because we discount future cash flows using the recurring rate of return. It means that we consider time value of money, right? So net present value depends solely on the forecast cash flows from the project and the opportunity cost of capital. The opportunity of capital is going to be reflected into recurring rate of return, right? Not just this opportunity cost of capital basically means the risk you're gonna take, okay? Because you have several choices to make, but based on your own based on your own forecasting, you take the highest opportunity highest opportunity cost of the choice with the highest opportunity cost, right? For being all measured in today's dollars, you can add up them. So if you have a several project A, project B, right? So if you carry out those two projects A, B, then you just need to add the present value of project A and project B. So then you're gonna have a total net present value. So you can add up using the net present value. You can add up all the project net present value to get the total net present value of the project. Okay. Payback period. The payback period is pretty simple, straightforward. So they said, let's say you have some initial investment, then how long it takes to get all the money back in the future, right? So I took this from textbook. So let's say you have a project A, B, C, and the initial investment is the same, $2,000. This period 1, period 2, period 3. In case of a project A, cash flow in year 1, 500, year 2, 500, year 3, 5,000, 5,000. When it comes to project B, 500 is 1,800. Project C, 1,800 is 500. So the payback period in case of A, C1 is just 500. So you still need to make you still have after having this 500, you still have 1,500 to recover, right? So year 2, total amount of cash flow you have is 1,000. Which means that you still have 1,000 initial investment to recover, right? But only year 3, when you make 5,000 cash flows, all the initial investment will be paid back, right? So that's why payback period is 3 for project A. Project B, as you can see, year 1, just 500. Year 2, accumulated total amount of cash flows is 2,300, 2,300. So then in year 2, you recover all the cash, right? That's why the payback period is 2. The same goes for project C. So pretty straightforward, right? So as you can see, we do not consider any time value money in this case. But if you consider time value money, as far as we know the recurring rate of return, future cash flow need to be discounted like this, right? So then based on this present value, the payback period would be different from these ones. Okay. So it looks pretty without considering time value of money, product B takes 2 years, right? For the payback of for the payback. But based on the discounted cash flow, the payback product B would not have any payback up to year 3. They do not have a complete payback up to year 3. Maybe there may be more cash flows after year 3. So then you may have some specific years of a payback, specific payback period. But as far as far as we know from these numbers, product B do not have any specific payback period. Okay, so any questions regarding the payback period method? This is pretty straightforward, right? Dongjun, any questions?
I guess I have no questions for now, Professor.
Okay. Clara, any questions?
I don't have any questions. I mean, I'm going to look at it again after the class so I can understand better.
Sure. Am I going too fast? Clara,
A little
you
bit.
think? A little bit. I'm a little bit fast. Yana?
Yeah.
See.
You skip a lot of questions, which are practical questions that we can solve and remember the process and how we can apply it. And then we almost on every class we have a new topic, and we cannot like firmly remember the previous one to build something on it.
Yana, sorry, could you say again?
Yes, 1 second.
Yana, could you say again? I could not get clearly what you said.
Sure. My idea was that we have several topics that are interconnected, and we move to the next topic without firmly practicing the previous topic. And if we have some problems with first topic, these problems will continue later.
Okay. Okay. I see. So you guys needed. So Yana, basically, you're saying that you guys need some more practice of the of each topic, right? So then it's gonna be much easier to move it to another topic, right? But then I'm gonna have a lot of pressure on time pressure. Okay. Next time I'm gonna have next lecture I'm gonna have some chances to tackle several questions from the previous chapters. Okay, so I'm gonna devote the next class totally to the solving some questions or related to previous chapters. Okay, which
We're
I
going
think
to solve on investments on bonds. Yes.
Yeah. So especially bonds, fixed income, and stocks. I gave you some answers to the previous questions, right? So I hope you guys had a chance to look at the questions and the answers. Okay, so you guys all received my answers, right, to the previous questions. Okay, but if you
Yes.
don't, yeah, if you don't understand, then please let me know. So, but again, I'm going to take some other questions that may help you understand better, especially the bond fixed income section. Okay, I totally agree that the bond section is going to be really difficult. Yeah, at first. Okay. Okay, it's for a 353. So where? Hey, please, it is always helpful. It is always appreciated if you let me know I don't understand, or if you let me know what I need to do more for you guys to understand better. Okay, I always appreciate that response. Okay, I'm not the one who just go my own way in terms of teaching you guys, because at the end of the day, you are supposed to know something well from me, right? Not just sitting on there and yeah. So yeah, please. Okay, see you next week. Have a great weekend. Any questions before we wrap up?
Professor,
No,
can I
have
say
a nice
something?
weekend.
Okay, have a great weekend. See you next Tuesday. Thank you. Bye-bye.
Thank you, Professor.
Professor,
Professor, bye.
Professor, can you hear me?
Bye.
Thank you, Professor.
이거 질문을